Have you ever wondered how your Social Security gets taxed? How about the new Secure Act? You know some of the highlights that come out of that? The Federal Reserve, such a huge role. Wouldn't you like to know a little bit more about them? Active versus passive management, totally different. How about real returns versus average returns? I'm going to show you how that works too, so stay tuned.
Retiring Well, brought to you by Centennial Wealth Advisory, financial advisors specializing in retirement planning and serving all of Northern Michigan. Retiring Well, helping you plan for a successful and comfortable retirement. Retiring Well, plan to retire well.
All right, listen, in this segment, I want to talk about Social Security, but I want to talk about how your Social Security is taxed, how they calculate that. Now, IRS has a publication that it's got a worksheet that takes you through it, but basically, it's as simple as this. You basically take half your Social Security and all your other taxable income, and you arrive at a number. Now, they call that modified adjusted gross income, okay? Again, you take half the Social Security that you're receiving, your other taxable income, and you arrive at a number, okay? Now, why is that important? Well, first of all, once I get that number, or what they call MAGI, or modified adjusted gross income, once I have that number, then they're going to look to see if I'm single or married, okay? If I'm single and that number hits $25,000, now from $25,000 up to $34,000, they're going to tax 50% of that Social Security you're receiving is going to be considered taxable income. Once you hit the $34,000 threshold, now 85 cents on the dollar of that Social Security is considered income. So two different thresholds there. Now if you're married, it's different. The first threshold, taking half your Social Security and your other taxable income, is going to be $32,000. Now they're going to look at 50% of that as being taxable income, and then when you reach $44,000, now 85 cents on the dollar is considered taxable income. Now, how does that figure in? Once I figure in how much is taxable income for Social Security, now I can take my taxable income, that Social Security amount that's taxable, and arrive at my total taxable income. And then depending on what bracket I'm in is going to determine what my tax is. Now, we don't want to forget that we also have a standard deduction we get to deduct. So let me just run you through a calculation and how this might be. Let's say that I've got $20,000 in IRA income. I've got $24,000 in Social Security taxable income. So I'm going to take half my Social Security, right, $12,000. I'm going to take my IRA income of $20,000, and I'm going to get a MAGI number of $32,000. Now, if I'm married, that's the top of that first threshold where none of my Social Security is taxable, right? Because I didn't go over it. So now I've determined that none of my Social Security is taxable income. So what do I have left? I have my IRA income of $20,000. So that goes into the pot. But now I get to deduct a standard deduction if I'm married of probably $24,000, $25,000, $26,000, which is going to totally offset all of that. So I've literally got $32,000 of income between IRA and Social Security, and none of it is taxable. So you can see, folks, that knowing this and how my Social Security is going to be taxed is very, very important. If you're somebody that would like to know how your Social Security is going to be taxed, then I encourage you, give us a call. We'll sit down, look at your income, see what your tax liability is going to be, so you can have a great income plan.
If you are retired or soon to be retired, let us help you plan to retire well. Centennial Wealth Advisory specializes in retirement planning and has offices in Traverse City, Cadillac, Petoskey, and Gaylord. We'll never pressure anyone to become a client. Our goal is to inform and to educate. Simply attend one of our live events or schedule a meeting at one of our Northern Michigan office locations for a free, no-obligation retirement review.
You probably heard in the news this new act that got signed into law called the Secure Act, signed by President Trump. What it stands for is setting every community up for retirement. Pretty interesting. That's why they call it the Secure Act. Now, there's a lot of highlights that come out of this, and I want to share them with you because some of these you're going to definitely want to know. First of all, we used to have the ability when you inherited an IRA, okay, this is not the spouse, this would be the kids or somebody else inheriting an IRA, they had the benefit to stretch that out over their lifetime. I mean, they could take the lump sum, they could do it within 5 years, or they could stretch it out over their lifetime. And then if they died and passed it on to their kids, they would have to keep that same lifetime number. But now that's gone. With the new law, there's no longer any stretch provisions. You have basically 10 years in which you have to take that money out. Now, it doesn't have to be done equally over the 10 years. You cannot take the money out for 9, but by the 10th year, you've got to take it all out. So that's very important to understand and know now. There's no longer an age cap to putting into an IRA. All right, so you can be 100 years old and still put into an IRA or contribute to an IRA. The key is you still have to have earned income though for that IRA. Now, this one is very important. It used to be that you had to take what was called required minimum distribution from an IRA in the year that you turned 70 and a half and then thereafter based on your life expectancy. Okay, so you could take it in that year, you had to do it the first year, but in that first year you had the ability to wait to the next year, you just had to take it by the tax filing date. But then in that year you had to take a double one, okay? But the new law says that if you turn age 70 and a half after December 31st, 2019, now it's age 72, not age 70 and a half. Now, if you turn 70 and a half before that date, December 31st, 2019, you're still under the old rule. You have to take it out when you're 70 and a half. But after that, 2020 and beyond, it's now age 72. Now, there's some other interesting things that came out of the law that you might want to know. If you took money out of an IRA before age 59 and a half, there was a 10% penalty. But there are some exceptions where you didn't have to pay the penalty if you met certain things. Well, there's a couple new ones they've added. One of the exceptions is for adoption expenses. If you have adoption expenses up to $5,000 and you want to take it out of your IRA to pay for those before 59 and a half, you're going to still pay tax on the IRA, but there's no longer a 10% penalty. Another area is qualified disaster distributions. Now I don't know what all the details of that are, but I imagine if you're in a qualified disaster zone, expenses up to $100,000 over a 3-year period, now you can pull out of the IRA with no 10% penalty. All right, so a lot of interesting things. Hopefully you found that valuable. If you think you might meet these exceptions or want to know some more of the details, then give us a call.
You know, Larry, great information. Thank you for doing those two topics. One, Social Security. We never can learn enough about Social Security. I feel like, it's an area that there's so many questions, and then you jumped into the tax piece, which I think often gets overlooked, especially when it comes to retirement planning. It can really change how it may make decisions. And also with that Secure Act. That's really new information, really important to know, especially if you're in that time horizon. That can really change things not only for yourself, but for legacy planning and purposes. But with the Social Security tax, one thing that I did catch that you missed there was, didn't talk a lot about, was almost like how there's double taxation when it comes to that, right? And, there's the chances as the more that you kind of climb that ladder there, not only does more of your Social Security tax, but then also that other income is becoming taxable. So, with that, it just goes again to talk more about planning and how that's important for you as somebody leading up to retirement if you're making those Social Security decisions on how just that little extra income can cause more taxation and almost like kind of a double taxation.
Yeah, and I think it's important too, guys, on that Secure Act to understand the ins and outs of that just and what impact it may have on you. One of the other things to mention is on a 529 plan, how you can take up to $10,000 from that to help pay down student loans. So that might be of value to you as you're looking at those numbers. But all in all, when I look at these areas, I look at how important it is for you to be planning ultimately. And these are a lot of topics that you may be able to figure out on your own, or that's where we're happy to sit down with you and just have a conversation about what are those areas of concerns for you and some of those topics that maybe an advisor would be able to help you with.
Yeah, guys, I had a meeting the other day with a client who wanted to retire, but they wanted to retire short of 65, so age 62. The two big things they were concerned about was taxation and health care. So I was able to show them with the kind of income they had, how much of the Social Security was going to be taxed. They actually going to be in a very good situation, and they were just very pleasantly surprised or pleased to find out that they could retire early, that wasn't as big a deal. So if that's important to you to understand or know, then let us know. Give us a call. We'd be glad to talk to you about it. Now, stay tuned, because in the next segment, I'm going to be talking about the Federal Reserve. We hear a lot about them in the news, but wouldn't you like to know a little bit more about them? So stay tuned.
We look forward to helping you plan to retire well.
All right, in this segment, I want to talk about the Federal Reserve. Now, you hear about them in the news a lot. It seems like, you know, when they're lowering interest rates, the markets are going up, and when they're raising interest rates, the market's going down. Why are they responding so sensitively to what the Federal Reserve does? Well, there's a lot the Federal Reserve is responsible for. Now, they were created in 1913. Now, there was a lot of discussion at that time whether they should be a private organization or a government organization. And there was a lot of controversy on Congress which way this should go. In the end, they ended up compromising. The board of the Federal Reserve is made up of government appointees and also CEOs of private large central banks. So it's a little bit of private and government in the mix. Now, what is their objective? What is their goals? First of all, they have a dual mandate. They want to, one, keep currency stable, make sure our currency is stable in the country, but they got a dual mandate in the sense that they want to control inflation and have low unemployment. Now, these two things are kind of opposed to each other because typically when you've had very low unemployment, inflation will go up because people's wages grow and there's higher demand than there is supply and prices go up, and they don't want inflation to get out of whack. Now, they like to see inflation be about 2%. Now, we've actually had that for quite some time. So how do they do this? Well, they control the money supply by buying treasuries, okay? If they go out and buy treasuries, they're basically increasing the money supply because they're putting money into the economy. But they can contract that money supply by selling securities, okay? So that's how they kind of do it. The other way they control the economy or the money supply is in the interest rates they charge. They become the bank to the banks. So when the banks need money, they borrow it from the Federal Reserve. Well, the Federal Reserve will loan it out to them at a certain interest rate. All right, that kind of becomes the baseline. So if the Federal Reserve is wanting to lower interest rates to fuel the economy a little bit better, then they're going to lower that federal rate in which they loan to the banks, which allows them to loan it out to everybody else at a lower rate. Okay, but here's all that being said, in trying to control the money supply, the biggest goal or objective for the Federal Reserve is to make sure there's no run on the banks. Okay, if you've ever seen that movie, it usually comes out at Christmas time, called It's a Wonderful Life, with George Bailey, maybe played by James Stewart. Remember what happened? All the people came to the credit union and they wanted their money right now. And James Stewart or George Bailey had to tell them, listen, your money's loaned out with this person, it's loaned out with that person. I can give you some of it now, but not all of it. That's what the Federal Reserve does to all the major central banks, so that there can't be a run on the banks and have it be detrimental to our economy. So hopefully it just gives you some tidbits about the Federal Reserve, maybe helps you understand a little bit about their role, which happens to be quite huge. Well, anyway, I hope you found that interesting. Hey, if you want to talk a little bit more about the Federal Reserve and maybe the impact it might have on your portfolio, then certainly give us a call. Guys, one thing I didn't get a chance to talk to with the audience is that, since the last recession after 2008, when the Feds kind of stepped in, they lowered interest rates all the way to a quarter point, left them there for about 8-9 years, and then they took what was a balance sheet of like $1 trillion and through these three quantitative easing programs basically raised their balance sheet to $4.5 trillion, right? And then about 3 years ago, they wanted to normalize things, right? So they started incrementally raising the interest rates, trying to lower their balance sheet, and by the time we got to the fourth quarter 2018, the markets had a fit. Here's what really concerns me, that gets me a little bit worried. If the Feds can't normalize things, means get things back to a place that they can maybe handle the next recession, then how are they going to handle the next recession? If they can't, lower rates significantly or create even more money out there when the next recession comes, how hard is that going to hit us?
Right, and that's where I think of looking back at the last couple of recessions. You go back 2000, 2001, 2002, took roughly, say, 2.5 years or so for the market to drop in half. And then you've got 2008, 2009, that was about a 15-month period for the markets to drop in half. And obviously nobody knows what the next recession may look like and everything, but it's one that definitely catches our attention as far as how quickly could that market drop? And like you're pointing out, Larry, what lever do they have to pull to say, okay, well, we can slow it down by doing this and everything with interest rates as low as they are right now? It's going to be a challenge.
Yeah, and this is times, when I think, guys, is, what an important time it is out there for you as an investor and somebody that's maybe nearing or in retirement to get a review, a second opinion of the account. Let us stress test that account. Let's see what maybe the potential downside is. We know what that pullback could look like to your portfolio. Maybe you're in a great spot, and that would just be insurance to know that you are invested appropriately. But you know what? Maybe you're not invested in your comfort zone, and you would want to know that. It's better to know that now than at the bottom, right? And to know that. So too often we heard people come into us after the fact, and I didn't understand my account could lose that much money at one time. And it's really would be good to know that now. So if you're out there and you're nearing retirement or in retirement and you like that second opinion, let us know. There's no cost, no obligation to that, and just give us a call, and we'd be happy to sit with you and review your accounts to help you make sure you're on target for your goals in retirement.
Now stay tuned, because in the next segments I'm going to be talking about active versus passive management, very important next time we get to the next recession, and real returns versus average returns. So stay tuned.
Hi, my name is Jack Clunder, and I'm a financial advisor with Centennial Wealth Advisory. My wife and I moved up here 13 years ago, and we have really enjoyed raising our 4 children in the beautiful northern Michigan country that we have. If you've been watching the show for a while, you know what we specialize in. If you are at retirement or near retirement, give us a call. Call the number on your screen. We can help go through all the different aspects of planning that are involved in retiring well. So I look forward to hearing from you.
Hi, welcome back. Listen, in this segment, I want to talk to you about what is called passive investing versus what we call active management. Two different things, folks, and it's something you're going to want to be very, very aware of. First of all, one thing that's out there that's it's growing in popularity is what we call ETFs, or exchange traded funds. Okay, like these, like a bucket of securities. All right, and basically once you put all those securities in that bucket, that bucket closes. Okay, there's no longer any trading happening on it. It's basically like an index. You're just basically tracking that bucket of securities. That's what an exchange traded fund is. Now they trade on the New York Stock Exchange just like a stock does. They're highly liquid because you can buy and sell them right on the exchange. But basically it's passive because there's no trading anymore going on with that account. That bucket, that ETF is going to hold those securities no matter what until you sell it. Okay, so you might find if there's no changes happening, then that's probably leaning more towards a passive account. The other thing is when you look at a mutual fund, for example, all mutual funds have objectives, okay? Meaning they have an objective to hold certain securities in that fund, in that account. Okay, now unlike an ETF or an exchange traded fund, there's trading going on within that account, okay, based on that objective in the securities they hold. For example, let's say I'm in what I call a large cap mutual fund. That's simply a mutual fund that has to hold large company stocks. That's what its objective is to do. And so that fund manager is going to buy and sell large company stocks within that portfolio. Now, even though that change is happening, you've got some management happening with that. It's somewhat passive in the sense that it's only going to hold those securities that it holds. all right? Now, the key factor to understand when you're dealing with ETFs or mutual funds is understanding what they hold and what they're going to do when market conditions change. Because if all you're holding is certain sectors or certain asset classes and you don't have effective diversification, then it's going to be very passive because it's not going to change up a whole lot, okay? Now, active management, these are going to be fund managers or portfolios that are actually going to change with the market conditions. They might not be held to objectively hold any particular assets within their portfolio. If they see interest rates rising and bond values maybe going down, then guess what? They can change that up. Maybe they can lower their exposure accordingly. All right? But what you want, when market conditions get such that, especially as we approach recessionary times, you're going to want to be careful what kind of account you're in, because you may find it necessary to maybe be more in accounts that are active that can change up rather than be passive. So if this is a concern for you, something that you want to understand more about, then I encourage you, give us a call because we'll gladly take a look at that for you.
Hi there, my name is Nick Greenman. I'm one of the financial advisors here at Centennial Wealth Advisory. Brand new to the Gaylord office. I'm here full-time now, and I'll also be commuting back to the Petoskey office as well. I'd love to hear your story and learn if I could help you manage your retirement needs.
Are you drawing closer to retirement or already retired? Do you feel confident that you have a plan in place for your retirement? At Centennial Wealth Advisory, we believe there are a number of areas within your retirement plan that must be working together. It's very important that you have a long-term income plan. You don't want to run out of money in retirement. And we believe that tax planning should go hand in hand with your income planning. So we have our very own accountant on the team to assist you. We also believe that you need to have your estate planning in order to ensure that your assets are left behind to your loved ones and or charities. Along with that comes insurance planning, whether that's life or health. Along with all of this, obviously comes your investment planning, which you need to have confidence will help you accomplish your goals and objectives. As you can see, there's a number of areas that you need to be taking into consideration when it comes to your retirement planning. We'd love the opportunity to share with you how we approach all of these areas within your retirement plan. Please call the number on your screen.
Hi, welcome back. Listen, in this segment, I want to talk to you about real return versus average rate of return. Two different things. So let me illustrate. Let's say you had an investment or portfolio that made or lost 50% the first year. Okay, it made 50% the second year. It lost again 50% the third year, and then again made 50% in the fourth year. Wouldn't you say that's a pretty volatile investment? Funny thing though, if you do the math on that investment, they would tell you that that portfolio or that investment averaged 0%. All right, but what if I had $100,000, okay, and the first year it lost 50%. That means now my investment is down to $50,000, okay? Then in the second year it made 50%. Now I'm back up to $75,000. All right, then it loses 50%. Now it's down to $37,500. And then lo and behold, the fourth year it's back up 50%. Now I'm at $56,250. Now, for an account that averaged 0%, this portfolio really lost 43.75%. Now, that's a big difference. And if you look at out there in most portfolios or investments, what is the return they're always trying to give you? Most generally, they're going to give you the average return. But the real return is much, much different. Now, I recognize that this is an example that's grossly exaggerated, because how many investments do you see losing 50% and gaining 50% year after year is? But very vitally important to understand the difference between the two different numbers, between real and average, because if I'm looking at my investments and I'm just looking at the average and it has a high degree of volatility to it, then what is really my real rate of return? Very, very important to understand, very important to know. If you're somebody that wants to know the volatility of your portfolio, most importantly, how it operated in 2008 in the last recession, so you can see what kind of volatility it could possibly have, then you're going to want to give us a call.
Great information, Larry. Again, trying to help you plan to retire well. And so with this active versus passive management, it's one where I know we're growing a little bit of a concern as far as where the market is reaching all-time highs. And that's where some of those passive investments are just going to continue tracking those indices. So a lot of you that have 401ks, and within that, you're typically tracking a certain index, such as the S&P 500. You're going to rise and fall as that index moves. And so ultimately, that's where, we may prefer a little bit more of an active management style, trying to transition from some of those heavier risk accounts maybe to a little bit more conservative posture as markets continue to increase in volatility. So something to be thinking about.
Yeah, definitely. And like what John says there with the active versus passive, the other thing to be really careful of right now is when you're looking at average versus real returns. When somebody's presenting something to you and they're showing you this great 10-year history, remember, it's now been over 10 years where we've had a big market drop, like an example of 2008. So returns can look really rosy, but it may not reflect of how a true performance is over time with the ups and downs of the market. So if you can, try to request a history that goes back further, and also really pay attention to that real return, because that will show you realistically probably what is more expected than an average over time. So if this is something you're unsure of with your portfolio and you'd like a second opinion, please let us know. We'd love to sit down, walk through things with you, and help you plan to retire well. We'll see you back here next week.